Welcome to Illuminati Silver. We tell the truth about silver. Today is Saturday the 2nd of November 2019 and we're providing our gold and silver weekly update for the week ending the 1st of November. We shall also discuss the considerable economic data published this past week and the Fed's reduction in interest rates. So let's investigate. Gold rose $10 last week from $1,504 to $1,514, having hit a high of $1,515 and a low of $1,481. In sterling terms, gold finished the week at £1,170. That's down £2. And in euros, it closed at €1,356. That's down €1. Silver rose 8 cents. From $18.03 to $18.11, having hit a high of $18.18 and a low of $17.59. In sterling terms, it closed at £13.99. That's down 6 pence. And in euros, it closed at 16.22 euros. That's down 0.05 euros. The gold to silver ratio rose slightly from 83.4 to 1 to 83.6 to 1. The Dow Jones closed on Friday at 27,347, up 301 points on the day and up 389 points on the week. And the Nasdaq closed at 8,386, up 94 points on the day and up 143 points on the week. And the S&P 500 closed at 3,066, up 29 points on the day and up 44 points on the week. Brent crude closed at $61.69, down 33 cents on the week, and WTI crude closed at $56.20. That's down 46 cents on the week, so both of them very little changed. The dollar index stands at 97.24. That's down 0.59 on the week. This past week has been incredibly interesting, not necessarily because of major moves in the price of gold, but in fact the lack of any major move in its price, as gold oscillated within a 2% range between its high and low, during a week of considerable economic data. We saw gold open up initially, then dip until the FOMC rate cut announcement, and then steadily rise, albeit slowly, and with not much price difference, peaking on Friday and holding reasonably steady near that peak. What actually curtailed gold's growth was the job figures announced on Friday, the US non-farm payroll report, as we announced in our video yesterday entitled Positive Job Figures, Effects on Gold and Silver, and we've put a link to that in the description box below. It is a very short video. It showed that not only did the US add an additional 128,000 new jobs in October, against expectations of just 90,000, but the figures for August and September were also revised upwards by some 95,000 jobs between them, suggesting that the US economy is still on a positive employment line growth that looks as if it is still growing despite all of the scaremongering that the pumpers would have you believe. In addition, the manufacturing indices, though not great, were practically, maybe just marginally lower, in line with expectations, and we should not forget that manufacturing made up only 11% of GDP in the second quarter of 2019, the smallest share of GDP going back to 1947, where such records began. So its significance is becoming less important to the US economy. Now, these figures certainly affected gold prices, and we'll explain why. On Wednesday, the FOMC reduced the Fed funds rate by 0.25%. Therefore, it's now standing at 1.5 to 1.75%. This was its third interest rate cut in just 4 months. However, in the press conference afterwards, Fed Chair Jerome Powell made it clear to reporters that the Fed saw that cut essentially as the last one in this rate-cutting cycle, and would only consider a further cut if the economy deteriorated rapidly and considerably from here. The job figures seem to suggest that the economy is quite robust, and so traders are now mindful that perhaps this is the end of that rate-cutting cycle, at least for now, and so the tailwind behind gold from a lower dollar perspective has now been reduced. This essentially stopped gold in its tracks, as initially the markets did not believe that the economy was in such good shape, but then the job figures came out. So, from a technical analysis point of view, though, we are in an interesting situation. October's highs for gold were around 1517, and this is where, on Friday, gold found resistance. There is certainly support just shy of the $1,500 level, near the 10-day moving average, with stronger support at the 100-day moving average of 1470. But the MACD histogram is pointing to higher prices ahead. So we have a situation where expectations of a rate cut in December have all but collapsed, which is bad for gold. But the technicals are suggesting potentially higher prices moving forward. Now, from a geopolitical point of view, the China trade talks seem to be going well, with China announcing that there is a, quote, consensus on principles, unquote. And whilst no specifics have been revealed, President Trump has been talking up the prospect of progress. So all seems well there. Russia and Turkey are now involved in joint patrols of northeast Syria, filling the gap left by the US, and we can only wait and see what happens there. The death of ISIL leader al-Baghdadi is good news for the US administration, though domestically the president is now facing a formal impeachment inquiry. Hong Kong is still pretty hot, with protesters ignoring the mask-wearing ban on Halloween, and its economy is expected to post negative 2019 growth as the many months of protests have adversely affected its economy. Now, from speaking with traders known to us yesterday, we are being told that the general consensus, save of course any major negative news coming out, is that gold is on track for further price rises ahead. But in the immediate short term, much depends on next week's trading. If gold manages to keep above 1500, then we can expect to see it test its 1557 highs and possibly hit 1600 before the year end. However, if it falls below 1500, then 1465 to 1470 will be the next determinable resistance, in that if that breaks, then we would see gold fall to its 3 months low of 1431. But all acknowledge that $1,400 will be extremely difficult to break below, at least as far as 2019 is concerned. Now, silver moved similarly to gold, save that the difference between its week high and low, rather than being 2%, was closer to 3.4%. For the same reasons mentioned with gold, we saw prices rise, then fall, then rise again on Thursday and Friday. From a technical point of view, we saw silver form a sizable hammer, which is a bullish sign. In addition, if one draws a trend line, we can see the current price sitting on top of it. Now we're referring to the 50-day EMA, again potentially suggesting higher prices ahead. Another factor, though, which we feel should be introduced here, is that providing the economic statistics are accurate, and the economy is not in as bad a shape as others suggest, then we could also see that the forecast fall in silver for industrial demand may not actually be as bad as some anticipated or at least projected. See, we often smile when we see the pumpers state that the economic figures are totally false and we're already in a recession with demand falling off a cliff. And then they advocate higher silver prices without appreciating that if that were the case, then the demand for silver from industry would collapse, and it would need a significant monetary demand increase to make up that shortfall. Interesting. Now, we see silver trading over the next couple of weeks within a $2 range, hovering around or just above the middle of that range. The range is $17 on the downside and $19 to the upside. We do not see this major lurch forward that many of our contemporaries predict, as frankly, we can see equity markets and the US dollar, and to some extent, although reducing, US treasuries still mopping up surplus investment monies, at least through November. That said, we are mildly bullish silver, but cannot see on the horizon any major development, save perhaps the China trade talks failing or some form of Middle East uprising, affecting its price to the extent to take it outside of this $2 range. At least not this month. Though once we've had the benefit of another 4 weeks' economic figures, then we may change our tune. But until then, it's $17 to $19, as far as we are concerned. Now, talking of economic data, let's take a look at what is being announced this coming week. On Monday, we have factory orders for September. Tuesday, trade deficit for September, marketing services PMI for October, and the ISM non-manufacturing index for October. Wednesday, productivity for quarter 3 and unit labor costs for quarter 3. On Thursday, we have consumer credit for September. And on Friday, consumer sentiment index for November and the wholesale inventories for September. So Tuesday will perhaps be the most impactful as far as data is concerned. Now, many have asked us if we believe that gold and silver will rise significantly and when. And a quick answer to that is yes, but when we are confident that the equity markets have run their course. We pointed out in a previous video podcast that historically much depends on whether the Fed is forced to reduce rates further from here or not. If they are, then this will begin to frighten equity markets. And whilst they like lower rates in general, 4 rate cuts historically will suggest that the economy is not in as good a shape as the government and Fed believe it to be, or encourages us to believe it to be. All of our inclinations suggest that there is still one bull leg left for equities. And when this is done, then we can expect to see some major hikes in gold and silver prices, but gold first, as money leave the stock exchanges and move towards safe haven assets. Now, we have produced quite a few videos highlighting the fact that funds and investment managers are now at last seriously looking at gold in a multi-asset portfolio, and this will secure it well into the future. It may take some time to see these moves, but providing you're not in a hurry, then sit back and let the momentum naturally develop. Thank you for listening, and please note, we have listed below the videos we feel have proven to be very important during these past 2 weeks. And if you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified as new video podcasts appear. This is important, as if prices are likely to move, we will respond very quickly and hopefully alert you in good time. We've also noticed, and I mentioned this in yesterday's video, that almost 40% of those listening to our podcasts have not subscribed. This means that YouTube does not then alert them to new podcasts coming out. 2020 will, in our opinion, be a truly exciting year for gold and silver prices in particular, and also for other precious metal prices too. So, as we intend to produce a video each day, and for our Inner Sanctum members, we'll be producing 2 quite long videos each week, then we would earnestly suggest that you subscribe if you haven't already done so, because it would be a shame to miss them, as there are reasons behind each of the videos that we do produce, because we tend to feel that they form a picture, both supporting why prices are either going up or going down, and also indicating the way ahead. And even on the odd occasion we may get it wrong, it will at least provide you with the information necessary so that you can help make up your own minds, whether you agree with us or not. Thank you for listening. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.